and discuss the trends in the realty space. There's a note by Liases Foras where they indicate that while luxury sales are doing well, it looks like we're at the peak of residential real estate sales. What else does the note say? We'll discuss with Pankaj Kapoor, who's the founder and MD at Liases Foras. Mr. Kapoor, good morning. Thank you so much for joining in. The trends that you have set out in your report do paint some grim picture that we are seeing. If you can summarize that for us, and do you think pan-India, the residential real estate sales will start seeing a decline versus last year from quarter 3?
Yeah, I'm saying that last 4 quarters, if you see continuously, there has been a marginal decline, not too much, but 1%, 2%, 3% quarter on quarter. So overall, there is 7 to 8% decline from its peak at all India level, which is covering 75 cities across India. But the major concerns which I am seeing that is emerging in terms of the construction progress. So if you analyze the market, the marketable supply or the launch supply has been increasing post 2020 pandemic. And we have seen from 3 billion square feet to 3.5 billion square feet of a launch supply, which has got introduced in the market. And any given point of time, market used to maintain 65%. And during the RERA time of 2017, when it was getting introduced, it touched 75% of the marketable supply as a constructed supply. But that ratio has been declining. It is touching in some of the cities around 50% or below 50%, what clearly indicates that in tandem to the increase in the launch supply, the construction pace is slowing down and it is not growing, and which is talking or reflecting the structural issues in the real estate sector. That means the builders will see a delay in the revenue recognitions in the project. The execution default in the projects will increase, as well as there would be a impact of the inflation, which will shrink the margins of the developer. So in overall sense that, sales is one aspect of the market, but the construction and productions of the real estate is actually not grown in tandem to the growth in the supply, and it has only slowed down all through from market used to maintain 2 billion square feet of constructed supply, which has been even today, while the marketable supply has grown from 3 billion to 3.5 billion. So clearly indicating there is a slowdown in construction, and there could be several issues there. But what is emerging in the market is like, the labor issues, delay in the approval, or there could be a funding issues in the projects which builders may be facing.
Mr. Kapoor, that was my next question. So are you saying that a combination of all of these issues, be it the labor issue, be it the funding issue, is contributing to this execution issues that these builders are facing? And also, is this, or are these issues being faced by the organized developers as well?
I'm saying that across the cities, across the markets, which we are seeing this particular thing, which is emerging, very hard to say. Different projects will have different kind of issues. Some may have approval delays. But what is emerging, while interacting with the developer, is that labor is a major concern. They're not able to increase the capacities to do the productions in line to the launch supply, largely because they are feeling the labor shortage. It's maybe very contradicting in the sense like the country like us is facing a labor problem, but that's emerging trend in the markets.
So, Mr. Kapoor, when we have conversations with the listed companies, their guidance is better than ever. They say, yes, we are towards the end of that multi-year real estate cycle that we talk about, but they have not been facing major issues as you have pointed out. Can you give us a sense of how is it in tier 2 cities versus bigger cities like Mumbai? Because Mumbai, the conversation suggested, could see double-digit growth going forward. Are we seeing this impact in certain geographies, or is it pan-India?
It's pan-India, although in the tier 2 cities, the launches has been much lower than the tier 1 cities. And so those market has seen a sharper decline. But my own sense is that we are seeing a growth in terms of the sales and supply. We are not seeing the growth in terms of the constructed stocks. So the builders' capacity to produce has not increased, but however they have been able to launch more projects and they were able to register good sales. So the point of view is that from sales point of view, everything looks very rosy. Inventory overhang point of view, we are at one of the most efficient phase of that, which is at tier 1 cities is standing at 19 months of inventory and tier 2 at 15 months of inventory. So sales and inventory overhang point of view, market looks very, very rosy. And that's what getting reflected in the market. But productions in the market is not increasing in tandem to the increase in the supply, which
So
should
what,
maintain a ratio.
so what would the impact be going forward? Just trying to understand, are we back to those 2016, 2017 times where we saw that major issue with delivery of apartments to buyers? And what does it do to pricing as well going forward?
Yeah, that is something which is actually emerging concern, in the sense like there would be a delays in the projects. Although the developers are taking a cautious approach, they are putting extended date when it comes to the RERA registrations. But having said that, like if they sell the stocks and if they are delaying the project, then the inflation start seeping in. And one more thing which you see, that the price increase across the projects has been very, very limited. So we are covering around 20,000 projects. Across these 20,000 projects, only less than 5% projects have shown greater than 10% of price growth. The majority of the projects have shown a price growth between 0 to 5%. If my inflation has been or increase is higher than the price growth, that means the margin will come into the pressure, and then the structural issue will come into place. Their cash flow will be strained. Their revenue recognitions, because of the slowing down construction, will be lesser or delayed. So I'm saying that overall cash flow will have a strained situations. I don't think so we will be seeing the similar problem what happened when the project got defaulted and prior to RERA, because now the RERA has come into place, and the builder are liable to comply with the deadlines and their penalties and many other aspects. But the construction pace has to really pick up, for them to avoid such kind of delay. Otherwise, there would be execution default.
Mr. Kapoor, there were plenty of other questions to ask, but running out of time. Thank you so much for sparing time and joining us today with your thoughts on what's the issues plaguing the residential real estate market. Take a short break, but just before we do that, a quick reminder for our viewers. HSBC presents Future Female Forward Season 3, co-presented by Cognizant from New Delhi. We bring you the newest state chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on the 25th of November, Tuesday, 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 and CNBC-TV18.com.